Hi, I'm Jeff with Haven Mortgage. Thank you for the great, yeah, exactly. But appreciate that, and I appreciate all you guys sending the deals over here. We love to keep everything in-house. I love dealing with all of your customers. You guys all have wonderful folks to deal with, so I love it. So yes, absolutely. I'm going to do kind of a 5 top questions for you. Today I'm only going to talk about one of them. And so let's start with, what do you guys think I get asked as my number 1 question?
Here, who said that?
How much money is it going to cost me to get a loan, or how much money is it going to cost me to buy a house?
Good question.
Anyone else? Yeah, Ty, go ahead. Then I'll go to Jesse.
What's the interest rate?
Okay.
What are the interest rates going to be 2 weeks from now?
Yeah, I get that one too.
Anyone else? Carrie?
Do I have to put 20% down?
Good one. We're going to go even more basic. How much do I qualify for? Right?
Which is kind of the consumer's way of asking all those questions, isn't it?
It encompasses a lot. And there's a lot of words in this one, so we're going to go ahead and kind of work through this together. But basically, how much do I qualify? How do we calculate that? There's a term that we use. Debt. DTI, debt to income ratio. So that's the main thing that we look at. We look at your income versus your debts on credit. However, the lenders are very good at also finding other hidden debts. So every now and then there's a mortgage that's gone through a bankruptcy that's still owed. We do find that. But basically today we're going to talk about how do we calculate our DTI, or debt to income ratio. So the ratio looks like an X over Y. X is your front end. Basically it's all your expenses minus housing. And then Y is your total expenses, including your housing. We're concerned about both, but Y is really the absolute catalyst of how high we can go on debt to income ratio. So conventionally, how high can we go? 49%, right? FHA? 57, and VA? 63, or however AUS basically gives us an approved eligible. But what we see here is we have layered risk, right? So what a layered risk is basically we look at your overall picture of what's your debt, do you pay your stuff on time, do you have any delinquencies, anything in collections. So if you have any basically negative effects on your credit score, that 49% goes down. So this is your absolute 800%, or 800 credit score, 20% down, no issues whatsoever on the loan. So we're going to talk about some math. Does anybody want to read this scenario?
Assuming $60,000 salary per year, 12 months equals $5,000 pre-tax per month. Am I read it all?
Sure. So we'll talk about that. So average salary around $60,000, right? So how we divide that is there's 12 months in the year, so you make $5,000 a month. Conventional lets you go how high? 49%, right? So we need to do some quick elementary math here. So we take 5,000 times 49%, and that gives us what total? $2,450. There we go. So that is the total debt to income ratio in dollars that you can have. That's going to include both your mortgage as well as any other credits that you have on debt. So let's say you have some small debts. Most people do have an auto. Some of us have student loans, and then I'd say most people have credit card debt of some sorts. Now the one thing we do exclude is any rent, because obviously you're not going to have rent when you move into your new house. And then utilities, we don't count those against you, because those are just kind of a cost of living, right? So basically, if we take that situation, we have our max total debt to income ratio in dollars of $2,450 and subtract out our $1,200 in debts that are already on credit. That's going to give your client $1,250 as a max mortgage. So then what we do, we reverse engineer. So we'll talk about that same situation, but basically put some numbers to it. So say we have a $300,000 purchase price, we put 20% down, $240,000 loan amount. Basically, taxes and insurance, we've added all this together. So our total housing expense is $1,857.72. Now what else do we have to add in there? The debts on credit, right? So what we can see here is with adding our debts on credit, now our total per month in total dollars of debt, including housing, $3,057.72. That's over our total limit allowed for $2,450. In other words, no loan on this one. So what do we need to do? Because your clients need that $300,000 house, right? Who has a suggestion of what we should do to get that debt to income ratio down? Yes, right? How can we do that? Can you get a seller credit? Can that pay off a debt? Yep. So really, this is really where I come in and I kind of balance all numbers because I can see everybody's credit report, right? So I can see exactly what's going to make the biggest impact to get that dollar amount the lowest. Typically, we have these like high interest rate loans, so it's like you borrow $1,000 but you owe $100 a month. We pay that thing off and we're good to go. We definitely try to get some seller credits because that makes things easier, but basically these are kind of the scenarios that we go. We can also buy points because that takes us down in interest rates, but mainly paying off debts.
Can I ask you a question about that?
Yes.
So let's say they're going to pull money from their 401k to pay off debts.
Okay.
Is that something that is just a contingency on the loan side? So let's say they have the money in the 401k, they're willing to do it. Mm-hmm. They can do that as long as they have the money and they pay it off prior to closing?
Correct.
Is that okay?
Yeah, and they don't have to pay it off prior to closing. They can pay it off at closing. The one thing that you want to look at with a 401k is, does your 401k allow you to borrow against it? Fidelity is the big ones. Yeah, they're usually pretty good, but there's a couple small ones that say, hey, like you can't touch this till you're 62 or something like that. So that's the one thing that we look at. But yeah, the 401k is your money. So they don't ever penalize you for using your own money. But obviously there may be some tax repercussions at the end of all this.
Do you have to see some sort of paperwork to show that they're demonstrating working towards getting that money in order to get the pre-approval?
No, like really what we'll do, the answer is yes and no. So really what we do is we just look at the total dollar amount that they have in there, and if it's usable, then we can say like, hey, yeah, we're going to pay it off, and then how they choose to pay it off is totally their choice. Yep. Good question, though. Okay, so we're going to go to the final slide. How much do I qualify usually morphs into, I know how much I qualify for, but do I suggest that you go that high? So just in case people didn't realize, so when we talk about debt to income ratio, we're talking about your pre-tax dollars. So basically, I wanted to just break this down for you so you could see really what this looks like. We take our $60,000 a year salary, and then basically off of like a tax calculator I got that basically just under $11,000 is taken out, right? So if we use our same situation, with our math over 12 months, basically it's going to give you a total income of $4,098 take home. And then with your max DTI, so basically if we go up to that 49%, that's $2,450. So that gives you $1,648 a month, to basically pay bills, internet, cable, Afterpay.
Are you going to Coeur d'Alene
My
tomorrow?
wife's sister uses Afterpay, I hate it. Credit card, food, auto. So basically, I learned a long time ago, I don't ever talk with my wallet, but I will always talk with their wallet. And this is a conversation I get a lot is, hey, should we go that high? And this is how I always break it down for your clients, just so you guys know how I do this. So whenever they say, hey, I'm comfortable with this number, you guys can sleep easy knowing like, hey, they're comfortable with this mortgage payment. So basically, if they say, yeah, we're comfortable with that, we fire away. If we don't, we go back to the drawing board, we lower the pre-approval amount, make things a little easier on their budget for them.